Hi, everyone. Thanks for joining. We're just still gathering, so we're just going to wait a minute or two. I see the numbers kind of increasing of attendees. So just sit tight for 1 minute or so, and then we'll get started. Thanks so much. Hi, everyone. Thanks for joining. We're just going to wait 1 minute more. We have some folks still joining. We're almost at the number of those who responded. So we just want to give folks time to join. We'll be starting in 1 minute. Okay, it's just 12:03. We still have some folks joining. We will be sharing this presentation. We'll be recording it and sharing it via the Human Resources website. We have a YouTube page, so we'll post the video there, the presentation there rather. You also have the opportunity to go in to the website and log in, and this presentation is also found there, but more on that within this presentation. So first, I'd like to introduce myself. My name is Lauren Ragone. I'm the Associate Director of Benefit Operations in the Columbia University Human Resources Benefits Department. Thank you so much for taking the time this afternoon. I would like to introduce to you our partners from Risk Strategies, Max Citarelli. He will be presenting to you today, and we'll have ample time for questions. So thanks again for joining. Go ahead, Max.
Thanks so much, Lauren. Hi, everyone. Good afternoon, and thank you for your time today. My name is Max, and I'm happy to be here to share some more information with you about the new long-term care benefit during this special one-time enrollment period. Today's presentation will take about 15 minutes, and then we'll use the remainder of our time for a live Q&A session. If you have any questions along the way, please type them in the chat, and we'll do our best to answer them as we go. As Lauren mentioned, this presentation is being recorded and will be available to you afterward on the Human Resources website. So what is long-term care? It's a kind of support someone needs when they're no longer able to care for themselves. More specifically, when someone needs assistance with everyday tasks or what we call activities of daily living, which you'll see illustrated here. Or when someone has a cognitive impairment. Think Alzheimer's or dementia as prime examples of this. Now, oftentimes we think of long-term care as something that happens in nursing homes or assisted living facilities. And while those are certainly common options, it's important to remember that care can also be provided right in the comfort of your own home. The need for long-term care can arise for many different reasons, and why some of those are linked to aging. Things like accidents or illnesses can happen at any time, at any point in our lives. And so on the next slide, we're going to review some stats that will speak to exactly that. How likely are you to need long-term care? Like I said, most people associate long-term care with older age and the retirement years, and they certainly wouldn't be wrong to do so. The Department of Health and Human Services estimates that 7 out of 10 people who are 65 or older will need long-term care in some form or fashion during their lifetimes. But as I mentioned on the last slide, accidents and illnesses can happen at any time. And this stat in the middle here from AARP is a reminder of that. In 2022, half of the people who needed long-term care were actually under the age of 65. So the reality is that long-term care can affect anyone at any age. Now, once you have a sense for the likelihood of needing care, the next question many people ask is, how long might I need it for? And that's exactly what this chart here at the bottom shows. On average, females need care for almost 4 years and males for a little over 2. And these averages align with life expectancy. Women typically live longer than males, so they therefore tend to need care for longer. Again, these are just averages. Sometimes care is needed for less time, and in other cases, it's needed for more. And that's that stat that you'll see in the top right-hand corner, that 20% of people will need care for longer than 5 years. Now, it's important to keep these durations in mind for both male and female, because you will have the opportunity to apply for coverage for your spouse, which we'll be talking about on an upcoming slide. Now that you have a sense of how likely it is to need care and how long it might last, the next question many folks ask is, how much might it cost? Now, like most things in our world, the cost of care continues to go up over time. And while we can't predict exactly what that will look like in 10, 20, or 30 years from now, we can use today's costs as a useful benchmark. What you see here are the median monthly costs in the United States based on the most common settings where care is received: at home, in an assisted living facility, or in a nursing home. Of course, these costs might be higher or lower depending on exactly where you are in the United States at the time you may need that care. Now, most people say that if given a choice, they'd prefer to receive care in the comfort of their own home. So the example we used here is based on in-home care. So when you do the math, the median cost for just 1 year comes out to nearly $80,000. But what's important to point out is that amount is oftentimes paid entirely out of pocket because health insurance and Medicare typically do not cover long-term care. And that is exactly why Columbia University is now offering this benefit, to give you access to coverage that's designed specifically to help with long-term care. So let's start by going over a few of the plan highlights. As a Columbia University employee, you can get coverage without having to answer any health questions. So this is a huge, huge advantage, because if you were to apply for this kind of policy on your own, say through a financial advisor, you'd have to go through a full medical review process. But as a Columbia University employee, even if you have a pre-existing condition, even if you have a complicated medical history, you cannot be turned down for coverage as long as you're actively at work and under age 71. The long-term care benefit is offered through what's called a hybrid policy, which means that it combines both long-term care and permanent life insurance into one policy. And so the advantage of that setup is that benefits are guaranteed to be paid, which makes it pretty unique when you think about most insurance products. So even if you never need long-term care, a life insurance benefit will be paid to your family at the time of your death. Or the policy could end up paying for both long-term care and life insurance. And on the next slide, we'll talk through a few scenarios of how that might work. As I mentioned earlier, you have the option to apply for coverage for your spouse, and we'll dig into more detail on that in a moment as well. And lastly, this coverage is portable, which means you can keep your policy at the same rates and with the exact same benefits if you leave Columbia University or when you retire. So while Columbia is giving you unique access to this coverage, once you enroll, once you have your policy, it's yours to keep. As an eligible employee, you have 6 different options to choose from, which provides you with a range of coverage and pricing options so that you can tailor the benefit to your specific needs. The chart you're looking at here shows only the coverage options, which are the same for all Columbia University employees. The pricing, however, is personalized. The pricing is based on your age, your tobacco status, and of course, how much coverage you elect. You'll be able to review your specific rates right in the enrollment website. And at the end of this presentation, we'll show you how to get there if you haven't already visited. To explain how the life insurance and long-term care benefits work together, let's talk through a few scenarios using option D. So if you can see my cursor, we're going to use option D as the example. With option D, you'd have a bucket of a total of $100,000 of long-term care benefits. If you need long-term care, after you satisfy the 90-day eligibility or elimination period, your first payment will be a tax-free lump sum. In this example with option D, that amount would be $40,000. And that amount is paid directly to you. So you can spend that money however you see fit. Each subsequent month after that initial lump sum payment that you require long-term care, you'd receive $10,000 per month until you use up the total bucket, the total amount available of long-term care, which again, in this case, is $100,000. Now, keep in mind, just like the initial payment, that monthly benefits are paid directly to you, and they're paid to you regardless of your actual expenses. So, for example, if you're receiving professional in-home care and that costs $4,000 per month, if you have option D, you'd still receive $10,000 per month because that's what your policy says. Now, if you never need long-term care, whether that's because you pass away prematurely or because you live a full life and die without ever needing care, that full life insurance amount, in this case, $100,000, would be paid to your beneficiaries as a tax-free lump sum at the time of your death. A third scenario may fall somewhere in between. So if we stick with that same example of option D, you might use $50,000 of the total $100,000 available for long-term care while living. And then at the time you pass, that remaining amount, in this case, $50,000, would be paid out to your beneficiaries as a life insurance benefit. So the easiest way to think about it is any benefits that you don't use during your lifetime for long-term care will be paid to your beneficiaries as life insurance at the time of your death. So no matter what, as long as you continue to pay premiums, the policy is guaranteed to pay benefits, whether it's for long-term care, life insurance, or both. Now you'll see this bolded up here, but something really important to keep in mind as you're reviewing these options. If you elect any coverage amount during this one-time opportunity, you'll lock in your ability to increase your coverage in the future, all the way up to the maximum if you choose, without any health questions required. Now, just two important things to keep in mind on that. In order to exercise the ability to increase coverage, you must be an active employee at Columbia University at the time of that increase. And two, the cost of any additional coverage in the future will be based on your age at that time. So the coverage will never be less expensive than it is now because we're, of course, all only getting older. So if you get coverage today and then you increase your coverage 5 years later, that additional amount will be rated based on your age at that time 5 years from now. So it'll therefore be proportionally more expensive. With all of that said, I would encourage you to at least consider enrolling in, say, option A or option B, just to keep the door open for more coverage down the road if your needs change. Let's go over a few frequently asked questions. First, how do you qualify for long-term care benefits? You must need assistance with at least 2 of the 6 activities of daily living, which you saw illustrated on the first slide, and you'll see listed here as well, or having a severe cognitive impairment. Again, prime examples of which would be Alzheimer's or dementia. A common follow-up question we get is, who makes that determination? And you'll see the answer right here if you can see my cursor, a licensed healthcare practitioner, which is defined as a physician, a registered nurse, or licensed social worker. There is a 90-day eligibility, also known as an elimination period, which you may have heard me mention on the last slide. What this means is that once you begin receiving care, there's a 90-day wait before benefits begin. So during those first 90 days, no benefits are payable. But as soon as you hit the 90-day mark, you'd receive that initial lump sum payment that you saw in the chart on the last slide. Again, it's important to point out that these benefits are sent directly to you, not to the care provider or to the care facility. And so what that does is it gives you full flexibility. You use those funds however you see fit. Based on current tax laws, these benefit payments are tax-free. And while you're actually receiving long-term care benefits, your monthly premiums will be waived. So you won't pay premiums while you're receiving benefits. As I mentioned earlier, you have the option to cover your spouse. A few things to keep in mind on that. You, as the employee, must enroll in order to apply for coverage for your spouse. And the amount of coverage you elect for your spouse cannot be higher than what you elect for yourself. Your spouse's pricing is based on their own age, not yours. So once you're in the enrollment website, you'll enter some of their basic information, and the system will then calculate their pricing options for you, which you'll be prompted to see after you make your employee election. And then lastly, just to keep in mind, spouse coverage is subject to a few health questions, which again, you'll see right in the enrollment website if you decide to apply for your spouse. Next steps. So to view your personalized pricing options, you can click this link here. This is the same link that was included in Tuesday's email from HR Benefits. A quick note, the premiums you'll see in the website are monthly, not per paycheck. The premiums for this benefit specifically are paid each month via an automatic ACH bank draft from your checking or savings account. The advantage of that is that if you leave Columbia University or when you retire, your coverage will continue seamlessly since you'll already be set up to pay Chubb, the insurance company, directly. Coverage effective date. Your coverage begins the day you enroll, even though you won't pay that first monthly premium until May 1st. So if you enroll today, February 12th, your coverage starts today, but you won't see that first premium draft until May 1st. So keep that in mind. Two other important reminders before we wrap up. All employees are required to enroll or waive by February 27th, and the means to do so will be inside that website that you see at the top of this page. And remember, this is a one-time opportunity. It won't be available again next year or even later this year during open enrollment. So we encourage you to take the time to review the options that are available to you and make the decision that's best for you. If you have any additional questions that we don't cover during this presentation or the following Q&A session, you can review the very detailed frequently asked questions document that was linked in Tuesday's email. It's also linked inside the enrollment website. You can call the number here to speak one-on-one with a licensed policy consultant. They're available Monday through Friday from 9 a.m. to 8 p.m. Eastern. And then, of course, you can always reach out to the Benefit Service Center at Columbia University. Again, this presentation is also being recorded and will be made available to you afterward on the Human Resources website, so you'll be able to see it there. Thank you so much for your time. That concludes the presentation. So now we'll open it up for Q&A. If you haven't already, please feel free to type in your questions in the chat. We'll have some questions read aloud, and I'll provide the answers to them.
Thank you, Max. Several questions. So I'm going to do my best here to consolidate them. If you could move to slide the benefit example slide with the options, because that'll be a good basis for a lot of the Q&A. First, Max, want to talk about pricing and premium, and then portability. So, if you could highlight how the pricing is calculated for this enrollment, and then discuss how premium remains level and the portability options, that would be very helpful.
Perfect. So First, in terms of pricing, again, this chart is showing your coverage options. In order to see the pricing, you need to go into the enrollment website because the pricing is personalized to you. It's based on your own age, your tobacco status, whether you're a tobacco or non-tobacco user, and then, of course, which coverage option of these 6 that you select. So the only way to see your premium is to log into that website that you saw, which is also linked to the end of this slide. The premiums are level. They do not increase as you age. So if you're 45 today, your premium will be based on what it costs for a 45-year-old. When you're 50, 55, 60, it will not increase because you age. Portability. What that means is that you can take this coverage with you. So you are going to own this policy. Whether you're at Columbia or not, the coverage will continue seamlessly. Your benefits nor your rates will change. So they'll be exactly the same as you pay while you're at Columbia. It'll be the same amount that you'll pay into retirement or if you were to change jobs.
Max, how long are premiums due on this policy? And is there any cash value or return of premium included in the policy?
There is no cash value associated with this policy. You do have 30 days from the day you get this policy to review it, and you could turn it in and not pay any premium. Anytime after that, if you were to cancel your coverage, which you can do at any time and for any reason, but you would not receive any refund of premiums at that point.
Thank you.
Remind me, what was the first part of that question?
Yeah, you answered it. Yeah, premiums were paid through age 120.
Oh, how long? Yeah, sorry, how long premiums are paid for. So the easiest way to think about that is you pay for the coverage until you use it, is the way I like to think about it. Because if you receive long-term care, if you need long-term care while you're receiving benefits, your premiums are waived. So you would no longer owe premiums while you're receiving benefits. If you pass away, if there's a life insurance amount payable, that pays out to your beneficiaries. And of course, the policy terminates. If you live until 90 without needing long-term care, you would continue to pay the premiums if you want to take care of the policy. The policy lasts up until age 121. So if at any time between now and 121, if you were to pass away or have long-term care needs, you could have this policy again, as long as you're paying premiums.
Okay. Thank you, Max. I want to shift focus here. A lot of benefit questions around the duration and the amount of the benefit. So if we want to just focus in maybe on option D here, Max, and let's talk through the life insurance amount, the total long-term care benefit available, the first lump sum payment, and really how the life insurance and long-term care interact with each other here. That would be extremely helpful. There are a lot of questions around duration of benefit and the amount of long-term care benefit available.
Yep. So the easiest way to think about this is around, I like to use the term bucket. This column here, if you can see my cursor is the total available amount of long-term care, depending on the option you select. So you can think about this like a bucket of coverage. And so again, if we use option D, rather than thinking about it in terms of how long this would be payable, think about it in terms of the total amount of money available to be used for long-term care. So with option D, that's 100,000. 90 days after you qualify for long-term care, you're going to receive 40,000 upfront, $40,000 tax-free lump sum check. Anytime you receive long-term care benefits, it reduces your life insurance amount. So if we just take this one step at a time, you start with a $100,000 bucket of care of long-term care. After 90 days, you receive 40,000. Once you receive that 40,000, if you were to pass away right then, your beneficiaries would receive 60,000, the 100,000 minus the 40,000 you already received. After that initial lump sum is paid out, each subsequent month that you need long-term care, you'd receive 10,000 per month. So if we just continue with this example, you received 40,000, then you receive another 10, until you get up to 100,000. Once you've received 100,000 of long-term care, that's the total amount available. you would have exhausted the benefits under the policy. So you'd have received all 100,000. And because you received 100,000, there would be no life insurance payable. If you were to receive 40,000 and let's say you were just to receive 1 month after that, so you would have received 50,000 while living and then you were to pass away, there'd be $50,000 left and that would be paid out to your beneficiaries as life insurance. So whatever you don't use in the form of long-term care pays out to your beneficiaries in the form of life insurance. If you never need any long-term care and you pass away before you ever need care, your beneficiaries would receive that full 100,000. So 100,000 is the maximum benefits that are available, whether it's broken up into life insurance and long-term care, just life insurance, or just long-term care. Just depends on the situation.
Thank you, Max. Max, can you discuss the 90-day elimination period or eligibility period? Does that need to be continuous? And if you could recommunicate the eligibility for this. So there's a couple questions around continuous and how I receive benefits.
Yep. So it does not need to be continuous. Eligibility period and elimination period are synonymous. You'll hear both of those words in the state of New York. It's referred to by the Department of Insurance as eligibility period. So that's what we use here. You can think about this clock, this waiting clock starts, as you can see here, when you needing assistance with 2 of 6 activities of daily living or have a cognitive impairment and are receiving care, whether that be at home, adult daycare services, or in a facility, whether that be a nursing home or an assisted living facility. 90 days later is when you receive that lump sum. I think one of the questions you might have been alluding to, Matt, is if you need long-term care, say you recover and then need long-term care again, you do not have to resatisfy that 90-day elimination period. So if you had some sort of accident, you received some long-term care benefits, you recovered, and then for whatever reason you needed it again, you could, once you meet the qualifications, you would start receiving those monthly payments without having to resatisfy that 90-day period.
Thank you. Max, are benefits, long-term care benefits eligible to be paid if I am international?
That's a good question. Long-term care benefits are only payable within the United States and its territories. So if you're outside of the United States and its territories, long-term care benefits are not payable. You must be receiving care within the U.S.
Yeah. And a follow-up to that, Max, is informal or family caregiving eligible for payment?
Yep. So you'll see that question in the FAQ document. In order to receive benefits under this program, you must receive professional care, so home health care provided through a home health care agency for at least 8 days per month, no minimum hours per day. So to answer your question around informal care, if you're purely receiving 100% informal care, you would not be able to receive benefits. But if you receive a minimum of 8 days in a given month of professional care, you'll qualify for the full benefit. And then the remainder of that month, theoretically, you could receive informal care and you'd still qualify for the full benefit. So to summarize, in order to qualify for benefits, you must be receiving professional care for a minimum of 8 days per month in order to qualify for the benefit.
Max, if I own a separate independent long-term care policy and I enroll in the Chubb program, is there any impact?
The Chubb product does not offset with any existing life insurance or long-term care insurance that you might already own. I cannot speak to the existing coverages that you might have, but when it comes to this product, it would not offset or be reduced by other coverage you may already own. So from Chubb's perspective, it would essentially stack on top of coverage that you already have.
Max, is there a waiver of premium once I'm receiving long-term care benefits?
Yes, you'll see that here. While receiving benefits, premiums for the policy are waived. So while you're receiving benefits, you won't pay premiums at the same time. In the example we gave earlier, if you recover and you want to continue the policy, you would pick up premiums at that point. But while you're receiving benefits, premiums are waived.
Yep.
Max,
Um,
if I can jump in, thanks, Matt. A couple of questions about enrollment. So, where to enroll? So, here's the website. We've included it in the chat, but where to find premium information? It's that website. Can they change their election? They already made an election because the email went out on Tuesday. Yes, you can. You have until the end of the enrollment period on February 27th to change that election. Also, two questions. What if they want to change their election after the enrollment period?
Yep.
So that's
So
one. Hmm.
you want me to answer that first, Lauren, or you want to ask me the
Sure.
other part?
Sure. And then I'll ask the second one. Go ahead.
So just so in the meantime, I started sharing the screen. So the link that you saw or the link from the email, this is where it would bring you to log in. You just need your uni and then your full date of birth. Make sure you're using the full 8 digits, 2 digits for the month, two for the day, four for the year to log in. To answer the question, you can cancel your coverage or reduce your coverage at any time and for any reason. To increase your coverage after the enrollment, that would need to be communicated to you by Columbia. There will be a specific period of time when that is possible to do. We don't have that finalized just yet. So you can reduce or cancel coverage anytime. For the coverage increases, there will be a specific time when you'll be able to do that, which will be communicated to you by the HR benefits team.
Yeah, and that's kind of the second question. A lot of folks are asking, why is it a one-time enrollment opportunity? And so, we've had a few different long-term care programs throughout the years. Some of you folks might be enrolled in Genworth or Trustmark, and the landscape of the long-term care programs are changing, and they are regulated at the state level as well. So in New York State, this is kind of a recent update that we're able to allow this program. So right now, the program's set up as a one-time opportunity. It does not mean that it couldn't be the future. We just don't know that answer right now. We've set it for this period to see if folks are even interested. We've had some interest over the years about this program, but that's kind of where we stand right now. In terms of kind of next steps, you will hear from the university if there is another enrollment opportunity. Of course, we want to ensure that everyone has access to, the full suite of benefits that meets their needs. Another question came in. I can't get in the portal. I'm having problems. There's a phone number right here on the screen, that 332-266-4144. Any questions getting in, go there. You certainly can reach out to hrbenefits@columbia.edu. We're all kind of manning the phones and being on the front line for you during this enrollment period. So that's all I have right now. Thanks, Max, and thanks, Matt. I'm going to go back to the chat and see if there's anything else coming up.
Yeah, thank you, Lauren. I think the only other thing I'd add to that in terms of the one-time opportunity is keep in mind the one of the main reasons as well is that you don't have to answer any medical questions to get this coverage. Long-term care is arguably one of the most difficult types of insurance to get on the individual market, say outside of the workplace, because of the medical underwriting requirements. And so as a Columbia employee, you have the ability to get access to this coverage without having to answer any medical questions. And because of that, huge buying advantage, right? Because Chubb is essentially letting any employees in the plan without knowing their health status or health history. That's why it needs to be limited to a certain time frame. So that's part of it as well. Go
Max,
back to
couple
sharing
question.
the deck. Yeah, go ahead, Matt.
Yeah, a couple questions around tax advantages or taxability of benefits. So I'll fill in here. So premiums for this benefit are paid on with post-tax payroll dollars. That will allow for income tax-free life insurance and long-term care benefits, uh, either one. Regarding specific tax advantages, we recommend consult with your tax accountant or consultant to see what tax credits are available to you if you live in New York or a different state. Okay, so premiums paid with post-tax, all benefits paid on a tax-free basis.
Yep.
Okay.
And you'll see the Internal Revenue Code if you're interested in that. It's section 7702B of the Internal Revenue Code. This is a federally tax qualified long-term care rider, which is what is also part of why those benefits are tax-free. So you can speak with your tax advisor or consultant about that further, depending on the state and your unique circumstances.
Max, can you highlight how the rates are customized to each participant? And if I increase coverage at a future date, how the pricing is calculated at that time?
Yep. So rates are based on your individual age. They're not age bands, they're not grouped together. So if you're 40 and your peer is 41, you are going to have different rates. It is based on your individual age. You'll see the rates that are specific to you when you log into the website. Let's use the example of you getting option B today at age 40. It's going to be based on age 40. You'll see that rate in the enrollment website. 5 years from now, you decide that you want to increase the coverage from option B to option C. So you want to go up $25,000 in coverage. Your initial 25,000 that you're getting today is based on you being 40, and that rate remains level. You'll be 45 when you exercise that increase. And so the additional 25,000, right, to get from 25 to 50, just that difference will be rated based on you being a 45-year-old, which will be more expensive proportionally than when you were 40. The older you get, the more expensive premiums are. From an actuarial standpoint, the older we are, the more likely we are to have an accident, illness, chronic condition that could lead to long-term care. So the insurance company prices these rates accordingly. The younger you are, there's an advantage to lock in your premium at the age you are at, as they will not increase as you age. So if you get additional coverage, only the rate goes up for the additional amount. What you get today stays at the age you get it at.
Max, glad you're on this slide. So a couple questions around, well, one is, if I utilize a portion of my long-term care benefit and I recover and no longer require long-term care services, do I still have remaining benefit available for future use?
Yes, if you don't use your long-term care and you recover. So again, let's go back to option D. If you receive 100,000, 90 days after you meet that eligibility period, you'd receive the lump sum of 40,000. Then let's say theoretically that you recover. So you would have only received 40,000 of that $100,000 bucket. That means you have $60,000 left in that policy. So if you recover, you would pick up premiums again. And then if you were to die, there'd be $60,000 of life insurance that's payable. Or if you needed long-term care again, you'd have $60,000 left to pull out of that bucket.
Question around really right in line with that. So the long-term care benefits are paid on what's called an indemnity basis. So what you're looking at here, we could just look at, option F to focus your eyes in. First payment is 80,000, and that is regardless if your cost of care is only 10,000. It is paid on an indemnity basis. It is paid directly to the policyholder, and that benefit is tax-free. If your cost is less, we still pay that 80,000, and that 80,000 can be used to support your family or used as any other income. And again, that is a tax-free benefit. Subsequent monthly benefit is paid on that 20,000. And again, if your cost of care is less than 20,000, we still pay the 20,000 directly to the policyholder.
Exactly. So you're not showing receipts. This isn't and you're only being reimbursed up to a certain amount. The payment is based on what your policy says, which is what this chart shows here. And you'll see that as this top bullet here. LTC benefits pay a fixed amount regardless of your actual expenses. That's what Matt was describing in using that term indemnity benefits.
A few questions around the 90-day eligibility period. So the way New York State Department of Insurance had approved this product to make available to employers and their employees is that the 90-day eligibility period, yes, it is a long time. It's 3 months, and that policyholder is in essence self-insuring, so paying costs out of pocket for that 90-day period. However, this policy would pay would pay retro to that day of loss. So on the 91st day, you're going to receive 4 times monthly payment to reimburse or supplement the out-of-pocket costs that you incurred during that 90-day period.
So you'll see here in the fine print, the first monthly payment is structured to pay 40% of the life insurance amount. So what Matt is saying is that 90-day clock starts the first day that you need care. For the first 90 days, there is no benefits payable, but then that first lump sum payment is essentially going back retro to day one. And so essentially upfront, they're giving you the benefits for the 3 months or 90 days that you were not receiving care, plus that first payable month, all up front. That's sort of the mechanics of the policy.
Yeah. Max, some questions here around a licensed healthcare practitioner. And do they need to be specific providers or facilities?
No. A licensed healthcare practitioner is defined in the policy as a physician, registered nurse, or licensed social worker. So those are the types of individuals who have the ability to be able to certify you as being unable to perform 2 of those 6 activities of daily living or having a severe cognitive impairment.
Max, are you able to provide a high-level overview of the questions, the limited medical questions that are asked of the spouses?
They're all in the website, but I can try to pull them up in a moment and see if I can read them to give you a sense. Again, for the spouse piece, let me go to that page. There's no downside of applying for your spouse. It won't impact your employee coverage if your spouse is, for whatever reason, declined for coverage. They're yes or no questions. I'll read them aloud or I'll sort of summarize them. The first question is, if applying for coverage, is your spouse currently hospitalized, receiving home health care, or receiving or applying to receive disability benefits? Now, to be clear, if any of these questions that I'm going to read are yes, you'll see a follow-up. There will be more questions that you'd have to answer. If they're all no, the spouse would automatically get the coverage. That's the first question. The next one is asking if the spouse has been treated in a medical facility, hospitalized, or disabled in the past 6 months, excluding flu or cold. The other one asks, in the last 10 years, have they been diagnosed or been treated for AIDS or tested positive for HIV? And then the last question is similar to the second one, which is asking if the spouse has been seen or treated by a licensed physician or other medical practitioner within the past 6 months, excluding flu, cold, or routine physical. So again, you'll see those in the website after you enroll as the employee. There's no downside of applying. If you answer yes, know that you will be prompted to answer additional questions, which will be reviewed by Chubb, and ultimately they will make a decision. They might also need additional information, which you will be contacted to provide. But those are the questions that you'll see right in the website. Keep in mind as well that spouse coverage is limited to spouses that are between the ages of 19 and 70.
Thank you, Max.
Yep. Any other questions?
Yes, I'm working through the chat here to summarize some of these. Just give me 1 second here.
I see a question about, you can go into the website, you can look at it, you can enroll without completing your enrollment and log out, and your information or your work will be saved, and you can go back later to complete it. So it will save your progress if you go in, you look at it, and you go back in at a later time. You can log in and out of that website up until the 27th. If you enroll in an amount and then you decide you want to increase it or you want to decrease it, you can go back in and edit your elections.
A couple questions about if I get married after I make this election, can I add my spouse? Or can I increase the coverage? And this is a one-time enrollment opportunity. So if you elect this program, going forward, you can drop it or decrease the coverage. But those are the only changes that are allowed. And then a few questions. I don't know if this was brought up, but if I never use the benefit, do I get my premium back? Um,
If you never use the benefit, the life insurance amount pays out at the time of your death.
right. Thank you.
If you never use the long-term care benefit. So no matter what, a
Right.
benefit will be paid under this policy, of course, as long as you hold on to the policy and continue to pay premiums. And when I say it's guaranteed is because this policy is permanent life insurance. So it's guaranteed to last up until age 121. So it's not, you can't outlive the policy unless you live beyond age 121. So at any time, even if you live to age 100, 105, you pass away without ever needing long-term care, that life insurance benefit is payable because this is permanent life insurance.
Yes, policy can be canceled at any time. There is a 30-day period from your effective date, which is called a free look period when you receive your individual policy. If you determine that you want to cancel, we will return premiums within 30 days. After that 30 days, there is no premium refund or return of premium if you terminate after that 30 days.
Yeah. So to add to that, thank you, Matt. After this enrollment, which ends on the 27th, once everything is processed by Chubb, you will receive an actual policy at your home address in the mail. This will be a 30-page policy with all of this very specific details of your policy. What Matt is saying is that you'll have 30 days to review that policy. If for any reason you change your mind, you have the ability to cancel the coverage at that point, and you still would not have paid the first month's premium because that first draft doesn't come out of your checking or savings account until May 1st. So you have a little bit of time to make sure you're reviewing that policy, make sure it's exactly what you want. That's what that free look period is in regard to. Anytime after that, you can cancel without any penalties or fees or any of that, but you wouldn't receive any premium back.
Max, just some questions around maximum benefit available and um, having a maximum of 200,000. I think it's important that we just kind of comment on um, this program being offered through an employer on a guaranteed issue, no medical for employees, and just some of the differences between what this program offers through Columbia University as compared to individual market and things of that nature. So like your perspective on that, and I can fill in.
Yeah. So again, this is a 200,000 you have access to without having to answer any medical questions. That's a huge advantage because, again, on the individual market. So if you were to speak with your financial advisor, for example, about getting coverage like this, you would have to go through a full medical review process, a blood urine test, a paramedical exam, height, weight, a review of any prescriptions you might be taking, so on and so forth. So none of that is applicable here. As long as you are actively at work and under age 71, you have the ability simply to just sign up for coverage and you can have it. And so that's a huge advantage that you only have access to as a Columbia University employee.
Max, can we revisit the issue ages of coverage? It's a
For
couple
empl-
questions. Yeah, a couple questions of, hey, if I enroll at age 70, does that mean my benefit terminates or my policy terminates at age 70?
Yeah, I'm glad you brought that up. So when I'm saying under age 71, that's just to get the coverage without answering any medical questions. Once you have that policy, it lasts until age 121. So it doesn't terminate at age 70. What I was saying around being under age 71 is that is the age limit for guaranteed issue, which is the term to describe that you do not need to answer any health questions in order to get in the plan. Now, employees between 71 and 80, do have access to apply, but they would have to provide evidence of insurability. So they would have to answer some medical questions to get in the plan. But if you're under age 71, you can get in the plan without answering any medical questions, and then your coverage lasts until age 121, or unless you say otherwise and cancel it.
Thanks, Max. A question here around how these premiums for these level of coverage compare to Chubb normal rates, and has Columbia secured discounts and things of that nature, and some questions around how do the Chubb premiums compare to the open market. So as a representative of Chubb, I can confirm that Columbia has received a special rates, special underwriting offers for all employees and spouses. As related to the open market, it is these programs tend to be less expensive, and then the underwriting piece is really the significant difference. Um, I'm unable to comment, specifically to carriers on how they underwrite individuals, but I think what you'll find is that the access to long-term care through Columbia, through this product, um, is has an advantage over the individual market. And Max, I'm not sure
Yeah,
if you can add to
there's too
that.
many. Yeah, there's too many variables to be able to just sort of compare apples to apples. So a few comments I'd make on that. First of all, this product specifically is not available on the individual market, so you couldn't go to Chubb directly and access this product. This is only offered through an employer-sponsored offering, like you have access to as a Columbia University employee. Again, you can't really compare this to something on the individual market because the biggest variable is having to go through medical underwriting. So you if we're both 45, but you're take a bunch of prescriptions or have a more complicated medical history, or take, height, weight is different than what their charts say, well, you might not even get coverage to begin with, or you could be charged significantly higher because of your medical status or medical history. So with, again, the advantage of this program is none of that is on the table. So all employees have equal access to coverage because there are no medical questions. So the only thing that is going to differentiate one employee's premium from the next is their age and then their tobacco status. Of course, tobacco users pay a little bit more because with this life insurance component, of course, mortality, tobacco usage indicates higher risk of mortality. So tobacco usage just changes the premium, but all else equal, the only difference is your age. So you can't quite compare what this would cost, generally speaking, on the individual market, because it's going to be so specific to that individual. Because on the individual market, you might get declined for coverage altogether, or the insurance carrier might say, well, based on your medical status or medical history, we're going to charge you X percentage more than our base standard rate. So you can't really compare it apples to apples because you don't have to go through any medical underwriting. But these are group rates, and that's the advantage of getting through a program like this, because you're leveraging Columbia University's buying power by bringing a pool of almost 20,000 employees strong together and giving them access. And so that's where Matt's point around a strong underwriting offer and strong rates are leveraged through large employers.
Thank you, Max. I just want to revisit issue ages, Max, for issue age eligibility for both employee and spouse. Um, so employees can enroll through age 80, spouses through 70. Now, that doesn't mean that coverage terminates at those ages. It remains in place as long as premiums are paid through age 121. Okay. Max, can you highlight portability again, please?
Get back to where that's mentioned. So portability, this is your coverage. Once you get this policy, file it away, whether it's no longer tied to your employment at Columbia. So if you were to leave Columbia University or you stay at Columbia University your entire career and retire, you take the coverage with you. Because you'll already be set up to pay premiums directly to Chubb via that automatic ACH bank draft, no paperwork is required. Your coverage will continue seamlessly. Your benefits don't change, nor will your rates. So you just keep the coverage. It is yours to keep. What Columbia University is really giving you is unique access. You're getting buying advantages and unique access to this coverage as a Columbia University employee. But once you have that policy, it's yours to keep.
Thank you. Max, can you please provide another overview of waiver of premium and when that would come into place?
It comes into play while you're receiving long-term care benefits. So remember, you'll see on this slide, there's a 90-day eligibility period. So that 90-day clock starts on the first day that you're receiving care and you're certified by a licensed healthcare practitioner as needing assistance with 2 of 6 activities of daily living or having a severe cognitive impairment. 90 days later is when those benefits begin. Once you start receiving those benefits, which starts with that initial lump sum payment, that's when your premiums would no longer be due. So while you're actively receiving long-term care benefits from the policy, you don't owe premiums.
I want to address a question here around Chubb's financial status. So first and foremost, this program is heavily regulated, specifically in the state of New York, and it's governed by state of New York Department of Insurance laws and approval. So the question is the insurance protected by any government fund if Chubb goes bankrupt? So a couple things. We have some of the highest AM Best, Moody's, Standard & Poor financial ratings. Most importantly, for every policy that we administer, Chubb is required to reserve. And reserve means if I purchase a $200,000 policy, Chubb has to set aside a $200,000 bank account for my policy. Okay. Um, we we are regulated to pay that policy to that employee as long as premiums are paid and the policy is in force. Second question that I want to address here is, can I pay premiums out of your HSA? It's a very good question. And again, I'm unable to give you tax advice, but I can share that long-term care premiums do have some HSA eligibility. It is based on age and how much you can submit through your HSA, and I recommend that you consult a tax advisor to see what your eligibility is for HSA funds to be used to pay premiums.
I saw a question briefly around how we get into the site. So I'm showing you the site here. You'll see an email that went out Tuesday morning around 8:55 a.m. from the HR benefits team. The link is in there. I will ask Matt if you could put that link in the chat as well. That would be greatly appreciated. That link is going to bring you to the page you see here. Just make sure you have your uni if you don't know it off the top of your head, and then your full date of birth. And if you have any technical issues logging into the website, you can call the number that's right on that screen.
Yeah, if a question here, Max, around exhausting long-term care benefits, if I use all my long-term care benefits, the policy terminates.
Correct. If you use the total bucket that is designated in the policy that you have, once you've exhausted all of those benefits, the policy would terminate.
Yeah.
We're coming up on the 1 p.m. hour, and we do have time to stay a little bit after to finish up some questions, and we will go through the questions after the webinar, ensure that all of them are addressed and potentially update, FAQs. So if there's anything pressing that wasn't addressed, if you can, I'm sorry, please just put it again in the chat. We were trying to get to them as they come in, but we will stay on and continue to answer questions. So thank you.
Yep. There's a question regarding HIV exclusion for spouse coverage. Yes, if that response is answered yes, that is a knockout question.
Not necessarily. There will be
Okay.
follow-up questions. If you answer yes to the question around being diagnosed or treated for AIDS or HIV, there would be follow-up questions that you would need to answer, which Chubb will review, and then they would ultimately either ask for additional information or clarification, or give you a response of yes or no. I also see a question around can this, if the spouse uses up their policy. So keep in mind that if your spouse gets coverage, there are two separate policies that are issued. So even in the event of separation, divorce, or even death of either the employee or the spouse, there are two separate policies. So there's no overlap between the two. Once your spouse gets their policy, they have their bucket of coverage, their benefit amounts that are in their policy, and the employee has theirs. There's no commingling of those two policies. They are completely separate and distinct. So an employee could use all of their benefits and their spouse could use none, vice versa. It's each individual gets a policy.
Max, can you highlight the accelerated death benefit for terminal illness, please?
If someone is diagnosed with a terminal illness, which is defined as given less than 12 months or less to live, you have the ability to access up to 50% of your bucket of coverage immediately. So let's go back to this example using option D. You're diagnosed with a terminal illness. You could get $50,000 out of the policy, right? Up to 50% of it right away. In order to do that, and you'll see this in the FAQ, coverage has to be in force for 2 years. So if you get the coverage this year, you would need to have the policy for 2 years before you'd be able to access that option. So just keep that in mind. The terminally ill is defined, by 12 months or less to live.
Yep.
And a lot of these questions almost all of the questions that we've addressed here so far are in that frequently asked questions document. That frequently asked questions document is linked in the email that went out on Tuesday from HR benefits team. It's also linked inside the enrollment website. You'll see it in the top right corner. So I really encourage you to review that frequently asked questions document. It's been built very organically over several years from doing webinars and things just like this. So there's a lot of questions that we've hit on that you can reference again just by reading that FAQ.
Max, eligibility of coverage is an important one here. I'm just going to read you the question. Can you please explain more about the 90-day eligibility period? It is retroactive. For example, if proof was submitted on day 60 of needing care, day 1 would still count. And is there a minimum level of care or hours per month to satisfy that requirement?
So if you submitted the policy or the claim after you're receiving care, yes, you would work with that licensed healthcare practitioner to determine when that first day was that you were receiving care and qualified for care. So if you just submitted the claim 60 days later, yes, it would be retroactive to day 1. So you would get those 60 days to count towards that 90-day eligibility period. And to my point earlier, particularly if you're thinking about home care where you're not confined in, say, a nursing or assisted living facility, the minimum requirement is receiving 8 days per month of care, professional care, right? So that's licensed, accredited care providers provided through a home health care agency.
I just want to confirm that a question came in that my spouse and I are the same age. We're getting the same benefit. Are my spouse rates higher or lower?
They will be the exact same. If you and your spouse are the exact same and also have the same tobacco status, you're either both non-tobacco users or you're either both tobacco users, your rates will be exactly the same. Keep in mind that it's your age as of May 1st, 2026. So if you have a birthday coming up, it could tweak your age. It's going to be your age as of May 1, 2026. That's what the website is going to show.
Yeah. Question here what is the difference between being certified, needing eligible long-term care, and documenting receipt of care? So,
So you need both. You need for a licensed healthcare practitioner to determine that based on your injury, illness, chronic condition that it's required that you need that care, and then showing that you're actually receiving that care, right? So it needs to be in that, say, physician's uh, plan of care, and then you actually need to be receiving the care as well. So they're kind of, they certainly go together, but they're technically two separate things, right? There's one that, say, a physician, for example, is determining that because of your situation, you need assistance going to the bathroom, getting dressed, eating, right, or moving around, or you're diagnosed with a cognitive impairment. And then the other side is that you're actually receiving care. So you actually have that licensed healthcare provider in your home, or you've actually been admitted to a facility, whether that be an assisted living or nursing facility, or you're going to adult daycare services, a minimum of 8 days per month.
you. Max, regarding spouse hospitalization, if it's maternity, and someone answers yes, can you please explain the process?
Just answer the questions to the best of your ability. There is some clarifications in the website that you will see in terms of what it asks. If the question is yes, they're not automatic knockouts. It will just prompt you to answer additional questions for Chubb to review. So I'm not an underwriter. I don't review these applications. Just answer the question to the best of your ability based on the way they are written. And again, if you answer yes to any of those questions, you'll be asked follow-up questions, and eventually, they'll get to the bottom of what the situation is and be able to make a determination.
Just to reconfirm, uh, long-term care benefits are only payable in the United States or its territories.
Correct.
If you live to age 122, Max, will we lose the benefit, or will your beneficiaries get receive the benefit?
If you live to age 122, I hope you all do. The policy would terminate at 121. So no benefits would be payable if you don't die or need long-term care and you live to 122. Never gotten that question before.
Max, for eligibility of long-term care coverage, um, does the plan of care need to be certified every month to demonstrate 8 days of care?
The insurance carrier has the ability, Chubb has the ability to require certification once a year, once you're approved on a claim. Right. That, and meaning they
Yeah.
can come back to you once a year for proof that you are still, have a cognitive impairment or still need assistance with 2 of the 6 activities of daily living.
Um, Max question, how long would you and your spouse have to be married for them to receive benefits or be added to the policy?
You just need to be legally married in order to apply for your spouse. And there's no amount of days that you need to be married for. So if you got married yesterday, you can enroll them today.
Yeah. And Max, life insurance is available international, correct?
Correct. If you were overseas and died, there would be a life insurance benefit that would be payable. If you were overseas and needed long term care benefits are not payable outside of the United States or its territories. Now, that said, if you can receive care anywhere in the United States, so right now you might be living and working in New York City, you might retire in California. This policy anywhere in the United States is applicable. Just outside, if you're living outside of the United States and you receive care outside of the United States, these benefits are not payable.
To confirm, Max, premiums are paid not through payroll deduction, correct?
Correct. Premiums are paid directly out of your checking or savings account via an automatic monthly bank draft. So in the website, it's really important to see that the premiums you'll see are monthly premiums, meaning you'll pay once a month, 12 times a year. So don't calculate them per paycheck, they're per month. The reason it was set up this way is because with long-term care insurance, the whole design of coverage like this is that you intend to keep it with you for the rest of your life through your time at Columbia into retirement, right? That's more than likely a lot of times when it is needed. So you get set up day one in the website that we've talked about. You'll be able to provide your checking or savings account information, your routing number, your checking number, and you'll get set up. And then starting May 1st, Chubb will automatically pull that monthly premium out of that bank account on the first of every month. Again, starting May 1st, 2026. However, as mentioned earlier, your coverage is effective the day you enroll. So if you enroll today, February 12th, and you were to pass away on March 12th, even though you haven't paid your first premium, as long as you meet the qualifications to have received that policy, that would be a payable claim. So your coverage is effective immediately, even though you don't actually pay the first monthly premium until May 1st.
Thank you, Max. A couple more questions coming in. Yeah, just to reconfirm, you can purchase this life and long-term care policy through Columbia, even if you have an additional policy, and the Chubb program would not coordinate with that individual policy. So you can have both.
Correct. There have been other long-term care offerings that have come and gone throughout the years at Columbia. For example, some of you might have Genworth policies that would not offset or reduce the coverage that you're getting through this Chubb offering.
$200,000 is the maximum coverage for employees to purchase.
Correct. You'll see this option F. That's the maximum amount of coverage that can be purchased. Keep in mind that all the way up to that 200,000 is not subject to health questions as long as you're actively at work and under age 71.
Yeah. Regarding, again, the elimination period, if I require long-term care services for 60 days, am I eligible to receive a long-term care benefit?
No, you need to meet the criteria here, needing assistance with 2 of 6 activities of daily living or having a severe cognitive impairment and receiving care for 90 days before benefits are payable.
Thank you.
And that is standard across the entire long-term care industry. Policies that you would have access to either through Columbia or outside on the open market are going to be the same way.
Max, enrollment website question. Does the employee need to enroll before they are able to see rates for spouse?
Yes, the employee needs to make their coverage election. Then after you make your coverage election, you'll be prompted to review spouse coverage options. And then you'll be brought to a confirmation page where you can go back to the employee page or go back to the spouse page and adjust accordingly. So you can, just select the amount, say, as an employee that you think you might want. Then you'll be prompted to see the spouse coverage options. You'll look at those options, and then you'll be brought to a confirmation page where you'll then see, okay, for me, it costs X. For my spouse, it costs Y. You know what? I want to tweak it in one direction or the other. You can click on the name of the person and go back to that page and update your benefit amount. And so you can sort of tweak ongoing. But in order to see the spouse amounts, you first have to elect coverage as an employee. And the reason is because you can't get more coverage on your spouse than you get for yourself. So if you get the $100,000 option D, your spouse can get up to 100,000. If you only get option B up to 25,000, your spouse will only be able to get up either 10,000 or 25,000. So the spouse coverage will be limited to what the employee gets, and the system is smart enough that it will only show you the options up to 100% of what the employee gets.
Thank you. Question, Max. If the median cost of in-home care is $78,000 per year as presented, and I elect a $150,000 benefit, does this mean I'm covered for roughly 2 years of in-home care?
It depends how much it costs. I can't tell you what it costs because there's a lot of factors, particularly where in the United States you're receiving care, what type of care you're receiving. Is it home care? Is it assisted living? Is it nursing facility? So it's really impossible to answer that question. What I would say, though, is this policy, I would never tell you that this is a end all be all to your long-term care or retirement needs. We all need to use multiple tools and resources to plan for the future. So you might be paying off your mortgage, right, which you can use as an asset. You might be investing in stocks and bonds. You might be paying into other annuities or other things. You might be contributing to a 401k. So all of these things are all different tools and resources to use in the event of emergency or in just during your retirement years. And so this is just one of those tools. So I would never tell you that this is an end all be all to your long-term care needs, but it's a meaningful tool that could hedge a ton of risk off of your plate by having a policy like this. $100,000, $150,000 tax-free is a lot of money. So will it cover every single dollar of your care? I don't know that answer. None of us do. But again, it's an important tool that would be a part of your overall financial well-being, financial planning. That's the way I would encourage you to think about it.
Max, if I pass away after 2 months, will my beneficiaries receive my life insurance amount?
Yes. So after 2 months of having the policy or after 2 months of receiving care, either way, the answer is yes. If you get the policy today and die 2 months from now, your beneficiaries are going to get the full life insurance amount. And that would actually be before you even pay the first month's premium. If the question is actually asking 2 months into long-term care you die, then any amounts that you didn't receive in the form of long-term care would be paid out to your beneficiary. So if you, again, going back to option D, if the first month you'd receive that 40,000, the second month you'd receive the 10,000. So that would have been $50,000 that you received while living. If you die at that point, your beneficiaries get the remainder, the 100,000 minus the 50,000 you've already received. So there's 50,000 left. That's what pays out in the form of life insurance.
Two questions regarding 90-day elimination period. One is, does the 90-day elimination period apply to terminal diagnosis?
No, the terminal illness would be payable immediately. If you are diagnosed with 12 months or less to live, you could take up to 50% of your policy immediately. So you would not have to satisfy the elimination or eligibility period if you're diagnosed as terminally ill. Again, keep in mind, and I alluded to this earlier, that you need to have the policy for 2 years to be able to access that benefit due to terminal illness.
Does the 90-day elimination period need to be continuous?
No.
Thank you. And then I was typing a response, but I'm just gonna verbalize it. All benefits are paid on a tax-free basis to you and or your beneficiaries.
This question came up. I answered it, but I wanted to share. So if both employees work for the university and are spouses, to maximize the coverage and the program, each individual employee should elect their own coverage. So if you're married, you both work for the university, elect your own as employees.
And there's two really important reasons why. Lauren, I'm glad you brought that up. One is, remember, spouses have to answer a few health questions. Employees don't have to answer any. So you should both each go in as an employee because you'll both have access to guaranteed issue. Also, spouse coverage is limited to option D, where employees can get all the way up to option F. So it's absolutely 1,000% in your best interest to each go in as an employee and apply for coverage separately.
Max, this was asked a couple times. Apologize, I didn't get to it. Spouse divorce, employee and spouse, if there's a divorce,
Yep.
is portability, policy remains in place, portability eligible. If you could just comment on that, that'd be helpful. Thank you.
Yep, we did touch on this, but there
Okay.
are two separate policies are issued. So right now, if you apply for your spouse and your spouse is approved for coverage at your home, you'll receive two policies: one for you as the employee, one for the spouse. Now, while you're together, before say death or separation, the premium would be paid out of one checking or savings account. In the event of death, divorce, or separation, all you would need to do is call into Chubb, provide a separate bank account to keep the policy paid out of two different bank accounts. Right, in the event of separation or divorce, if both of you wanted to keep your policies, you would just need to set up two separate bank accounts to pay them. In the event of a death, again, you just need to make sure that the bank account that is paying those premiums is active, but there are two separate policies once they're issued. So none of those things would actually impact the coverage of the other. And anytime you need to go, you can call Chubb directly to change your bank account information. If you need to make any updates, you can change your beneficiaries, right? Again, in the event of death or divorce, if you want to change your beneficiary to your kids instead of your spouse, for example, you can do so.
Here's a question about spouse health and coverage except for tobacco use and not working normally. Those were the only questions they saw. Where are the other questions you mentioned?
Yeah, so if you're there's a depending on the amount of coverage you get, you might not be subject to all of those health questions that we
Okay.
described. So if you don't get those questions, if you apply for one of the lower amounts and if the spouse, if the employee applies for a certain amount and the spouse applies for significantly less, usually 50% or less, up to certain maximums, you only be prompted to answer just that one question of, is the spouse currently hospitalized or receiving long-term care? So if you don't see more questions, you didn't do anything wrong, just based on
Great.
the coverage amount you elected.
Max, can you
Another,
talk?
oh, go
Yeah.
ahead.
Oh, thank you. Max, if I terminate employment and then I also miss direct bill ACH payments, can you outline what the status of the policy will be at that point?
So terminating employment will have nothing to do with your policy because again, you're not paying the premiums through payroll. You're paying it directly out of your checking account. So Chubb wouldn't even know if you left Colombia because again, you're just paying directly out of your checking account. If you change your bank account or you terminate one of your bank accounts and premium is unable to be drafted in a given month, you'll receive communication from Chubb letting you know that you have an outstanding premium and you can call in and address whatever that may be. If you need to provide new banking account information, or whatever the case may be, but you will receive communication if you miss a draft. And that's also important for the first draft. If you don't, if it's not successful because you accidentally punched in the wrong bank account information, you will receive communication from Chubb. So just be mindful of that. Again, May 1st is when that first draft will occur.
I was typing it. I'm gonna just verbalize it here. Yes, of time. Um, Question is, I need to pay my premiums until 121 every month, correct? And the answer is yes. Um, Policy remains in place with no reduction in benefits through age 121. Um, if you begin to receive long-term care benefits, the premiums will be waived at that time. But to answer your question, premiums need to be paid every month for the duration of your policy through age 121 for benefit eligibility. Questions around beneficiary need to go to probate. That is a very good question, and a question Generally speaking, yes, unless there is a irrevocable trust or a trust document set up. That is definitely something I would recommend that you consult your attorney or your tax advisor.
If that wraps up the questions, Lauren, unless you have anything additional, we can jump off. And then again, everyone, this has all been recorded and will be available on the Human Resources website.
Yeah, I'll just do one final call out, see if there's any questions. Um, we're getting a lot of thank yous in the chat. I'll
Again,
just give
I
it.
encourage you to take a look at that frequently asked questions document. It has a lot of detailed information. This benefit deck will be available. It's linked inside the website. It's hyperlinked under benefit overview. It's the deck that we reviewed here today. And again, the recording, the YouTube link will be available on the Human Resources website.
Pete just posted the FAQs. I see someone just didn't get their question answered. I'm going to give them my email address and they can reach out to me directly and we will make sure it gets answered. Anything else? Okay, it looks like we're good. Thank you so much, everyone, for taking the time. Thanks, Matt and Max,
Thank you
and
so much
take
for your
care.
time. Hope everyone has a great rest of your day. Take
Have a
care.
great day. Take care.
Thank you.